Good evening, everyone. I'm just going to walk you through government debt in Canada with a focus on provincial and federal government. So my presentation is one perspective. As I always encourage people, go out and walk to the bank sites, go out to any sort of government think tank to get a different opinion or perspective. Here's a little bit briefly about myself. I'm a CPA CGA by trade, and I focus on getting information out. So I'll talk about growth rate by provinces, I'll talk about GDP, I'll get into key ratios, and I'll talk about the issues at hand. This chart quickly just gives you an idea that from 2010 to 2014, the average growth rate in Canada was 1.4%. And if you look at the provinces that did well beyond that 1.4%, they were resource-based economies. So you're seeing Alberta up there, you're seeing Saskatchewan, you're seeing BC up there. So you're seeing those are the ones that led to growth. What does that growth mean? Well, those growths provide extra dollars, and what we've seen in terms of the equalization funds that helped Ontario and Quebec with additional money to support their budgets or their action plans in terms of social programs. Let's look at growth rates. This is just quickly to give you an idea that we are in a period of slow growth. It's been there since 2002. It's not something that's just going to happen overnight because we have a demographic shift. We also have issues with China's not growing as fast as it used to be, so they don't need our resources to make manufactured goods. And that needs to be bear in mind too as well. And that's what I want to frame it in that perspective. GDP, this one I want you to take away from here is Alberta in 2014 exceeded Quebec and became the third largest economy in Canada. Now, let's talk about budget deficits and debt, because these are critical discussions that get kind of swept under the table by mainstream media. When you're in a deficit position, it means you're spending more money than you're taking in. That deficit becomes part of the net debt. Now, if you see ratios above 35%, and what you're seeing here in a lot of cases of the provinces, that means at some point you're going to have to deal with that debt. It also means you've been spending way beyond your means for far too long. And a lot of those factors could be a couple of things in play. One is we've seen across Canada a huge issue with government compensation. That means they're up to 5 to 20 for 10% more they're paid in the private sector. That's not sustainable. We're also seeing problems with value for money. We're seeing that they're coming in and not delivering the programs for the maximum dollar. We're also seeing bad policy shifts, whether that means pro-climate change, hydro rates and all that are driving these significant impact on the provinces in terms of their ability to attract business and manage their costs. That's things you need to bear in mind. The other thing with net debt that you need to understand is that government rating agencies look at debt. They rate that debt. If you do get a downgrade, that debt forces a premium up those bonds, and that forces up the interest rate. That's something that's not discussed. A lot of finance ministers, both at the federal and provincial level, do not sleep at night knowing that they're afraid of a downgrade. A downgrade's not a good thing. And that's something to bear in mind. Now, going forward, we've got significant challenges in this country. With the exception of BC, every province is in deficit, even the federal government. Now, you have to be aware of Keynesian economics. And what Keynesian economics is the government puts money into the economy to help it go on. That works maybe a little bit if you tactically make those purchases into key things like drives exports or profitable transit run. But if you're just increasing spending, and you're not really looking at the overhaul, how are you going to get back down from deficit? It is a dangerous game because at some point you will have to address that either through higher revenue or program cuts. So it's something you need to bear in mind when you're talking to your MPs, MLAs, or MPPs. You need to have that discussion. The other thing too with these debt calculations, they do not include pension funding. There's a huge issue with public sector pensions that are underfunded. They're not included here, so that number would actually be quite higher. You also don't have the municipal debt, which also would force it up too as well. So we are in significantly economic challenges now. So how do you do that? You do not bring shock and awe. When I mean shock and awe, you don't bring more policies that will not promote foreign direct investment. It's foreign direct investment that brings in capital that helps expand projects. Third thing that you want to do, you want to basically focus on getting that environmental assessment process down. What that means is I want to get these projects off the market so I can get the goods going to market. That's something that's critical in order to drive the economy. And that's something that people should be pushing their politicians. If you want strong economy, you need to approach policies that will drive foreign direct investment. They create that job climate. And that's not something that's discussed. It's easy to say, I'll create 100,000 jobs, but how are you going to do it? What policies are going to drive that? It's never one policy that drives anything in terms of economic growth or taxation. It is a multitude of things that will generate the economic action. Thank you.